To help us dig a bit deeper into what's behind the market volatility, we're joined by Andrew Karolyi. He's a Cornell University professor of finance and asset management and the author of the new book, Cracking the Emerging Markets Enigma. With us from London is Alastair McCaig. He's a market strategist with the investment firm IG, and with us here in Washington is Yukon Huang. He focuses on China's economic development and its impact in Asia and the global economy. That's at the Carnegie Endowment for International Peace. Thanks to all of you for joining us. Yukon, let me start with you in the studio. How do you interpret the current volatility on the markets? What's behind it?
Well, there's a lot of uncertainty in the world. Aside from the U.S., which is recovering, the rest of the world is still sliding in some cases or stagnating. Markets are more interconnected. If you think about it, 10 years ago, China's stock market collapsed by similar magnitudes. No one seemed to care. China's exchange rate is fallen before the recent adjustment, fell by 36% vis-a-vis the dollar. A 2% now change shakes the market. I think the issue is China's now the second largest economy. When it does something, it basically is a bigger signal for the world, more so than it was 10 years ago. But the government doesn't do a very good job in communicating its intentions. The markets hate uncertainty.
So, but the Chinese economy, being the second biggest economy in the world, now has a far greater influence on economies throughout the world.
Absolutely. Through its trade flows, through its capital flows. People expect, for example, that more money is going to be coming out of China in terms of foreign investment than the United States. It's getting bigger. It's the largest trading economy, so people worry a lot. And when the rest of the world's not doing well, China matters.
Alastair, in a recent interview, you said, and I'm quoting here, "I think the aggressive reaction we've seen in the equity markets have arguably forced the Chinese government's hand here." Explain that to us. What did you mean?
Well, I think when we look at the Shanghai composite, it's worth remembering a couple of things about this in regards to, as an equity indice, it is a relatively juvenile one in comparison to many of the sort of more established global equity exchanges around the world. And also the proportion of investors that it has are slightly more disproportionately tilted towards the retail environment rather than the institutional environment, and therefore they are prone to being a little bit more reactionary, a little bit more emotional in their trading activities as well, and therefore a little bit more increased in their volatility. I think the sell-off that we'd seen in the equity market was pretty aggressive, and arguably a lot of the Chinese investors out there had been blessed with equity in an equity environment where they'd been used to effectively one-way traffic, and they had become acclimatized to positive markets, generally speaking, heading in the right direction. An aggressive correction like this was something that they didn't as a general unit feel particularly comfortable with, and the government needed to establish a bit of stability as much as anything else, and some sort of action was probably required on the back of that.
Is that the reason why we do have a rally right now on the market in China?
Well, I think it's certainly contributed. It's worth, again, when we look at the actions that the Chinese regulators and the People's Bank of China have taken, they maybe are a little bit unorthodox in comparison to what sort of central banks in Europe or central banks in the US might have previously taken. And the recent action that they've taken in regards to reducing the reserve ratios and also reducing the base rate is maybe an action that is more prone to be or associated with Western equity investments rather than necessarily the Chinese. So maybe it took a little bit of time for that to stabilize. I think a bit of strong arm tactics as far as institutions were concerned inside China as well, to try and encourage them pretty aggressively to renew some of their investments there as well has certainly helped, and quite frankly a natural exhaustion as far as the sell-off was concerned.
Andrew, I was reading a piece by Nicholas Lardy with the Peterson Institute for International Economics, and he says there's little evidence that China's economy is slowing significantly from the 7% reported for the first part of this year. Wage growth is running at about 10% annually. The pace of creation of non-agricultural jobs is stronger than any recent year. Real disposable income and consumer spending are growing strongly. He says China is experiencing what he calls an overdue correction in the equity market. Do you agree?
Well, I think one thing we know we're seeing here in China is volatility. And those of us who have been studying these markets for a good long time have understood that at the core in China, the markets, as large as they are, as large as they have become, are clearly susceptible to these large bursts of volatility because of the fact that the markets are relatively not very deep and certainly not very resilient. And so what those of us who are scholars of these markets and look at the sort of the longer term perspective on these, what we try to do is understand why these fundamental attributes are such. There's no question that the economy is slowing down in China. There's too many signs of that. What I think is capturing our attention now is the fact that this is a very large equity market and that it has this lack of resilience and it displays these unusually large bursts of volatility. And now the rest of the world cannot help but acknowledge that through what you might call international financial contagion, or maybe there are good fundamental reasons for these spillovers of these bursts of volatility.
Yukon, a problem there with resilience. There was a recent column in the China Morning Post by the CEO of Country Risk Solutions, Daniel Wagner. In it, he wrote that, quoting here, greed and inadequate regulation that led to the Great Recessions of 2008 has not stopped. Regulators need to do a better job of enforcement, and risk managers must focus on managing risk rather than skirting rules. Mm-hmm. Pointing the finger at China will not achieve that end any more than blaming America for what happened in 2008.
Oh, he's got a point. Regulators should be curbing risks. They shouldn't be exacerbating the situation. The equity market surge in China is different from the surges we've seen elsewhere because it had a very large government-driven aspect. The government signaled it wanted equity markets to rise. It wanted to be more important in the financial system. Those are all sound objectives. But you also have to be careful about overdoing it. In this particular case, Chinese regulators actually encourage people to go in far greater than it should have been the case, rather than trying to moderate the risks involved.
Alastair, you've pointed out that August has always been renowned as a month for thin volumes. Could that be part of the reason?
Well, certainly in the European arena, it definitely accounts for quite a bit of the volatility we're currently seeing. The bottom line, of course, is that with school holidays and vacations on, there are a lot more adults out of their workplace, and trading floors around certainly the city of London and across the rest of Europe are that much thinner than they might normally be, London being the primary equity exchange in the European arena. And it's only next week when schools go back, and it does play a part, certainly, as far as volatility is concerned. A lack of liquidity always brings that extra dimension into the equity markets.
Andrew, so much of this, we are told, is about perception, sentiment, emotion. We had a French minister, Ségolène Royal, who said that the impact of the Chinese sell-off has been very limited on the French economy. She said, look, it remains an extremely dynamic country.
I think that's a fair characterization, but the reality is that we have to tip our hat to China and China's markets, ever increasingly more so over time. So I hope Ms. Royal is not short-sighted in all of that. Those in the markets are well aware. But I think if I can comment on the earlier suggestion as to what might be at the core of all of this volatility, this rise in volatility, secular rise in volatility, and the global spillovers, comes from research that I've done and many others have done, looking at the fundamentals in these markets. And the fundamentals go well beyond the participation of the People's Bank of China or actions that they take with respect to margin credit or reserve requirements. That's very short term in terms of perspective. What sets China apart, and what we need to remind many of those in the markets, is that and particularly the regulators in China, is that there is this enormous corporate opacity or general opacity in the markets. And this is what inhibits the resiliency in the markets. So what we need is to have the Chinese Securities and Regulatory Commission, the Banking Regulatory Commission, to rededicate itself to a much more rigorous disclosure standards within those markets. That will bring more active, research-driven participants to the market to deepen, create greater resilience, and to mitigate, to some extent, this sort of long-run secular rise in the volatility.
Yukon, what's your view on that?
Well, the markets need to be deeper. In China, the equity markets, in fact, have not been a good measure of what's going on in the real economy. And the economy is double what it was 10 years ago. But until 2014, it hadn't risen at all. In some sense, because there wasn't enough companies in the service sectors, private sectors in the market. It was largely state-dominated. In that sense, the activities of the market weren't represented with the strength of the economy, which has largely been private sector-driven. The government needs to also figure out how much intervention it needs to do. I mean, the market's stabilized, it's bounced back, but there's still a little bit of concern whether how much of that bounce back is because of government support rather than intrinsic strong support by the market participants.
Alastair, to what extent are we seeing this as a result of China's transition from one type of economy to another, from what has been described as a command economy to a market economy?
Well, all of the issues that we've just addressed there and the guests have addressed as well, we're all kind of roughly dancing around this same issue in regards to the makeup of the constituents, the trading environment that the Shanghai Composite has, and the Chinese investment arena has as well, in regards to arguably the lack of education and the lack of, proportionally speaking, institutional investment there. But it's also, again, when we look at the exchange and we look at the economy, they are two different things. And the link between the two is not as maybe clear-cut as some other equity exchanges on a global arena. So in regards to the likes of the inability of the Chinese economy to reach that 7% target this year, I think increasingly trading, the city, for instance, here in London, is more and more sceptical that that's going to be achievable. That being said, though, that doesn't necessarily affect the way that the equity markets have been trading.
Andrew, talking about change, talking about transition, there was an interesting piece in China Daily. It said the Chinese economy is in the middle of a significant transition. The old path of investment-led and export-driven growth is no longer viable. What China needs at the current stage is deeper structural reforms and a fairer say in the global financial system. Yeah,
it's correct in its general tone, but the fact is that the leadership in China is well aware. The new leadership in China is well aware of the need for this transition. They need to build up their consumption base to divert away to some extent from the sort of investment-driven and export-driven marketplace. This is a long-term project. One thing that they've also recommitted themselves to, but still, in my humble opinion, at a relatively slow pace, is towards opening up their marketplace to the institutional community around the world. That's the Alastairs of the world who need to have greater access. Their clients, in turn, are craving for them to gain greater access. I think this can only be a good thing. It will help to deepen their markets, and it will help to, let's say, rehitch the markets back to the real economy. When we talk about the fact that these are discordant, the large $3 trillion equity markets in China from their large real sector, I worry because we know that ultimately a fundamental dislocation in the equity markets is going to have real consequences. It's just too much of a truth to the way in which the world works. So while I hate to think that we might be dismissing the importance of this volatility, this dislocation that we observe in bursts, as sort of a sideshow that we don't need to reckon with. I know that I'm confident the Chinese leadership is well aware of that.